Welcome to Everything Co-op, bringing you information on how cooperatives can help improve your quality of life. This show is being sponsored by the National Cooperative Bank, NCB. The NCB is dedicated to strengthening communities nationwide for the delivery of banking and financial services for the nation's cooperatives, their members, and other socially responsible organizations. For more information on the power of community ownership, visit ncb.coop. That's ncb.coop. Now stay tuned for your host, Vernon Oakes.
Good morning, everybody. Happy New Year to everyone. This is Vernon Oakes. Welcome to our show this morning. Listen, we had a lot of excitement yesterday. It's unfortunate, but the coup, the insurrection, all of that was happening around the Capitol in Washington, D.C., and we're here to talk about cooperatives. And in cooperatives, there's ownership that's democratically controlled. There's this sort of voting, and everybody has a chance to say what's on their mind. And so we end up don't having insurrections and stuff in co-ops because people, they really share in and the transfer of power happens. But this morning, we're going to talk about housing cooperatives. And the Limited Equity Task Force in Washington, D.C. was put forth by Council Member Anita Bonds. And somewhere in that task force, which I happen to have been a member of, she came up excitedly and said that co-ops, housing co-ops, are the answer to gentrifications. Because you know what happens in gentrifications, particularly in black neighborhoods, whether that's Harlem or Shaw in D.C., now it's Ward 8 in D.C., because in Shaw, as gentrification happens, the prices of housing goes up. And when the pricing of housing goes up, the property taxes goes up. It seems like maintenance goes up, insurances go up, and people on fixed incomes or low incomes, whether they are essential workers or not, they cannot afford those housing. And so they have to move out. And in D.C., it was what we call Ward 9. That was Prince George's County, or they would go back south. In New York and moving out of Harlem, they would go over to Jersey, or they would go out into Long Island. But they had to move somewhere where the price of housing would be lower. Limited equity co-ops, they are the ones that help the price of housing to stay down and affordable. And it could be for workers, essential workers that need to be there, whether they're nurses or they stock the shelves of the food. Everybody that we say are essential that don't get paid as if they're essential, they now can afford housing with limited equity co-ops. And then they have a say. They have a vote. They have a say in what goes on in that co-op. They share ownership. And these coups don't happen in the co-op world. And to talk about that this morning, we have Mr. Hugh Jeffers. Good morning, Hugh.
Good morning, Vernon. Thanks for having me on the show. I'm real excited about it, and I'm looking forward to talking about housing co-ops with you.
Well, I love talking about co-ops, and particularly housing co-ops, because housing co-ops is how I got into this co-op world. I got into it, Hugh, by managing housing co-ops. And finding out the beauty and excitement of this co-op and how they blossom and bloom people. How did you get involved in co-ops?
Well, it's sort of a multi-level story, to be honest. My mother's family is from Minnesota, and Minnesota happens to be a state where housing cooperatives, especially for seniors, are very popular. And when I had just graduated from high school and right before I went to college, my grandmother moved into a senior housing co-op in Minnesota for the last several years of her life. And it was sort of my first exposure to cooperatives when she did that. And right now I have a brother who's much older than me living in Minnesota that also lives in a senior housing co-op. And then from a professional standpoint, I started my career. I grew up always wanting to be an architect, and when I went to college, I didn't study architecture. I actually studied art and economics. I had a double major. I went to Lafayette College in Easton, Pennsylvania. And when I got out of college, I thought about going to architecture school, but I went a different path, and I ended up having an interest in doing real estate development and things along those lines. And I started working for a company called Kenneth Leventhal and Company in Washington, D.C., that was highly respected real estate consulting firm at that time. And the first few years of my work career, I spent actually doing workouts for wealthy developers. And I found that very unfulfilling. And I started looking around to use my skills in a different way. And I approached that from looking at companies that were focused on affordable housing. And I actually found the National Cooperative Bank. And at the time, it was NCB Development Corporation, and I was hired on there, and I started as a loan officer there. And what is now Capital Impact, NCB Development Corporation, I ended up managing their affordable housing team for a little while. And I gained an interest in the FHA insured mortgage process there, and cooperatives certainly. And from then on, I've always focused on working with cooperative housing.
Isn't it exciting how you think you want to do something architecture and you end up doing something else, and then you stumble on, and then you stumble on, and then that creates your career. And so your career has now been in more as a loan officer. Is that right? That's what you've been doing the last?
That's correct. For 25 plus years, I've been a loan officer or a lender. And I've also, in addition to working with cooperatives professionally, have spent the past 9 years on the board of the National Association of Housing Cooperatives. I chair the Preservation and Development Committee there. So I wear sort of two hats in the cooperative world. I work with NAHC to promote new development of cooperatives as a solution to the ongoing housing crisis in this country. And I also, from a professional standpoint, provide development funding for those projects. Well,
Hugh, I don't know if you know this or not, and I did not know you've been there for 9 years already, but I was on that committee in NAHC, Preservation Development Committee, for maybe 15 years before you came on. Okay. And it was out of that committee that this radio show was born out of that committee. And it is very interesting. Herb Fisher, who's now in his 90s, it seemed like he was old as dirt when I first met him, now about 25 years ago, and Roger Wilcox, who passed, unfortunately, 2 years ago at 97. They were older, and they took me under their arms, wings, if you will, and taught me this co-op world over those 15 years. And they had it, Hugh, that if you could get developers to build co-ops, then people would buy them. And when we would go to our annual meetings, we would ask developers to come in and talk, and that was our whole focus. And after listening to that for 5 or 6 years, I came back to them I was teaching marketing at Howard at the time. And I came back with them with my marketing hat on, and I said, fellas, no, I wasn't teaching then. I was running it. So at any rate, I had taught marketing. So I said, fellas, from a marketing standpoint, people don't know about housing co-ops until they don't demand housing co-ops. If you can get people to understand housing co-ops, then if they demand them, then developers will build them, and people then will buy them. And that's what's missing. And I thought they were going to boo-hoo me down. They embraced that idea. And so we created the Public Relations Committee in NAHC out of that. We went to NCB and talked about that. And then I was on my cousin's show, who's Pat Norton, who's the developer. I was on her radio show one Wednesday in June 7 years ago. And the person that runs the radio station came out and said, you should have your own show. Because I was there, June was housing month. And I was there talking about cooperative housing and the development of them and how they work. The same thing we're going to be asking you to talk about here. And she said you should have your own show. So I went back to NCB and said, here's an idea. Would you support us? And they've been our supporter for these whole 7 years, not only financially, but really helping us to understand who are the other people in this housing. There are 4 sectors of cooperatives. Who are those other people, and getting them on and all of that. They've been a great, great, great sort of friend and partner in this radio show. So, yeah, We had something in common, the National Association of Housing Co-ops and the Preservation and Development Committee within that.
Right. Well, just to sort of round that out a little bit, I know that Herb and Roger both took you under their wing, and I had the pleasure of, right before he passed, spending some time with Roger and learning from him, who certainly is probably the most experienced housing cooperative individual I ever met, through his Foundation for Cooperative Housing in the 60s and 70s. He built 35,000 units of housing cooperatives, primarily using FHA mortgage-insured products. So I had the pleasure of working with Roger for the last few years of his life. The other thing I should just bring it full circle, Herb Fisher is still on the Development and Preservation Committee and still pushing us hard to make the decisions that we need to promote new cooperative development. So I guess the moral of the story is once you are part of this cooperative movement, it stays with you for life. So
for life. And those two guys, they really, really, really love co-ops. And Roger would start almost every conversation when he started with the history. He'd start with 1954 and bring you up to that date. So, he taught a lot of co-ops. So now, what exactly are you doing now?
Well, I work with a company called Centennial Mortgage. We are a small boutique firm where you do FHA-insured mortgages, and I also originate some Fannie mortgages as well. But the company is a very small, nimble, very experienced FHA mortgage lender, and they're also one of the very few lenders that has a portion of their business focused on housing cooperatives. So that's the group I work with. They're a great group of people. I'm excited every day to get to work. When I come in, they brought me in to start a cooperative lending platform. So I'm very happy being with them.
All right, we're going to take our first break, and then we'll come back and we'll talk more with Hugh and give us some examples of the projects he's working on. We'll be right back. Please don't touch that dial. Welcome back, everybody. This is Vernon Oakes. The radio show is Everything Cooperative. We talk about co-ops. Right now, today, we're talking to Mr. Hugh Jeffers, and we're talking mainly about housing co-ops. There are 4 different types of co-ops, and it depends on who owns and controls the business. If the employees own and control the business, then it's called a worker cooperative. And therefore, any business you can think of could be owned by the workers and therefore be a worker cooperative. If it's owned and controlled by the people that uses the products or services, then it's called a consumer cooperative. The consumer owns and controls the business, and that's where housing co-ops fall, credit unions, some food co-ops. There's a health clinic in Madison, Wisconsin that's owned and controlled by the patients. Food co-ops could be owned by the workers or by the consumer, the people that shop there. And then if a group of people or companies come together to buy the products and services that they use, it's called a purchasing co-op. Farmers are the main ones that use that. Artists are beginning to use it. Hugh, there's the purchasing co-op in D.C. that's called a Consumer Purchasing Alliance that churches, charter schools, nonprofits, they come together and buy the products that they need. Get a better price. Normally, the company learns the vendors, know the vendors, create a contract and everything. So that works out good for them. And then the fourth one is a group of people or businesses come together and buy the products or services that they need. Or no, they market their products and services. And these are called marketing co-ops. And sometimes they're called producer co-ops. And companies like Cabot Creamery, Orlando Lakes, Ocean Spray. And then there's an artist co-op in Pittsburgh called Ujamaa, which it means cooperative Enterprise, and Kwanzaa. So these are marketing co-ops. So those are 4 types, and we're talking about housing co-ops, which is a consumer co-op. That's the main thing we're talking about today. So Hugh, we said before we took the break, we'd come back and we're going to ask you, because you're working for Centennial Mortgage, you got interested in this because your grandmother was in a senior housing co-op when you were in high school or coming out of high school. And that was several years ago, so that got you excited about co-ops. So I said to you, I'd want to come back and ask you about what are some of the projects you're working on right now?
Well, it's hard to jump right into that without giving a little background. I think there is significant interest in the cooperative model right now, and it comes from various different areas of concern. And one of the big areas is that the nonprofit development community has gained an interest in the cooperative housing model as a way to provide affordable housing in the long term. And also, the nonprofit world finds the model very consistent with its own values. They have a democratically controlled housing. It helps uplift the community. It helps individuals who may not have access to home ownership have home ownership and gain wealth through the process. So a lot of the projects that I'm working on currently are with the nonprofit community that find their values consistent with the cooperative model. And one of the projects, one of the groups I'm working with is in Seattle. It's a group that the name of the group is Forterra. Forterra is actually started out as an environmental nonprofit. Their objective was to consolidate land to maintain environmental balance on the land. And as they have done that over the years, they have expanded into the idea of consolidating land in cities such as Seattle or Tacoma and using that land to benefit the local community. One of the projects that they're working on is a new cooperative construction project, which is called the Wattajir Cooperative. That cooperative is going to be, Forterra is working with a local mosque, actually, to promote this project. And it's going to be targeted primarily to the Somali immigrant community in Seattle. It's the project's being built near the airport in a community called Tukwila. It'll be 100 units. And it will be a mixed income project, with a portion of the units being affordable to individuals making less than 80% of their median area income. The project will also have a commercial space on the first floor, and that commercial space will be a separate cooperative owned by the people who will be selling products in that commercial space. And that is going to be modeled after a traditional souk, which is a marketplace in Somalia. And this project has been really, it's in its early stages of development. It's going through the HUD 213 program for its financing, which I'm helping them with. And it's been really well received by the community. They, like I said, have 100 units. And even before construction starts, they have over 200 families that are signed up to be members of this cooperative once it's finished. It's really a tremendous project, and I think it will go a long way to supporting the local community and really act as a focal point in the community, the larger community as well.
Okay, so I want to go back over this a little bit for you so I can get understanding and people out there can also. The name is Wattajir, Watergia.
It's Wadajir. And I think the meaning of Wattajir is coming together. It's a Somalian word. And that is the focus of this project, bringing the community together and providing housing for a community that sorely needs it.
Sounds like a housing and a market. The marketplace, like souk, I think is what you called it.
Yeah, it's a souk.
Somalian souk. That's okay.
Yep.
Okay. 100 units. So 80% of the median area income in D.C., the median area income is almost 100,000. So 80% would be people of 80,000 or more. In D.C., the people that need it are probably making 50,000 or less. So that's 50% of the median. The people at 80% need it too because housing prices in D.C. have gone up so high. But in Seattle, Washington, how does this work, and what's the median income, and what kind of?
And I can't quote the specific number, but Seattle is a very high-priced market. Median incomes are very high. I'd say it's probably similar to D.C. I mean, Seattle is a tech-oriented market. It's Microsoft nearby. So housing.
Amazon is there. Amazon is there too, aren't they?
That's correct.
Okay, Amazon, Microsoft. Okay.
Yeah, I would say it's probably very similar to D.C., but the housing is out of reach for most folks. And 80% of median area income, I would say, is probably close to $70,000, $80,000, similar to what it is in D.C.
Okay. I just looked it up. It's 80,000 in Seattle. Bellevue is 98,000. Kirkland is 100,000. So we're in that same price. 80% of 80 is 64,000. Yeah. So $64,000 to $80,000 is what they're looking at.
Right.
Okay.
And the way Forterra is approaching this is they are a real sophisticated nonprofit. They have a lot of resources. They will be bringing some soft money into this project, both through state and local programs, and also through a significant fundraising effort to make it more affordable. So they will be bringing a tremendous amount of resources to help also with individual members and supplementing their share price purchase as well. So there's a lot of effort going into making this affordable, given the market as a whole being so expensive.
So what is soft money?
Soft money? Oh, that. I'm sorry. I'm thinking as a lender. Soft money is grant money, money that it does not have specific repayment terms, and there's usually an affordability requirement that is required for that money to be put into a project, and it's usually local governments, state governments, sometimes federal money that supports making a project affordable.
Okay, so listen, we got to take our second break, and when we come back, I would like for you to talk about the funding of Wajir. Okay, so we'll talk about the different places of how you get money and see if we can talk about another one. We'll be right back, everybody. Please don't touch that dial. Welcome back, everybody. This is Vernon Oakes. Our guest is Hugh Jeffers. He was talking about a project in Seattle, Washington. Hugh, I don't know if you worked with the Northwest Corporate Development Center in Seattle, but there's a guy named John McNamara who was on the show, Dr. John McNamara, who's totally in co-op. He's got his master's degree and doctorate in cooperative in a school in Nova Scotia. But it's interesting. I thought about him when you said values. The nonprofits, this co-op model fits their values and mission, and that he, in part of his dissertation, worked on an index to go out and measure these co-ops and how well they are doing with the cooperative values and principles, and how well they are doing, how successful they are with their mission. And it would be interesting if that same index could be applied to this nonprofit and how well they're using cooperative model to maximize their mission and be more successful with their mission and their value systems. But what I wanted to ask you about, we'll try to see if we can talk a little bit more about that, but I'm more interested now in, I understand there's 5 to 7 layers of funding to get one of these affordable housing things up, where HUD may be the bigger chunk of it. You've talked about soft monies, but HUD could play a role of guarantee funding to some bank or some other group, or they could really put out the hard money, the actual dollars. So what's this funding for this group that you're talking about, this 100 units in Seattle that's mainly for Somalian immigrants that's called Coming Together?
Yeah.
How do you put that funding together?
Well, it's a process. It's sort of like baking a cake. I mean, there's many layers to it. Typically, for what you would experience with a market rate co-op is that your funding would come from primarily two sources. One is the blanket debt. That's the construction mortgage and permanent mortgage on the property, and then the rest of the funding eventually comes from the membership shares that are sold to the members. So your total development cost for a typical market rate co-op would equal the blanket debt plus the membership sales. With an affordable co-op, you may not be able to maximize your blanket debt or your share membership sales because you're trying to create a project that's affordable. So your rents or your carrying charges will be lower than what they would be for the market. So the amount of debt that you would qualify for would be lower. And your membership sales would be lower because you're trying to make it more affordable. So that typical model that you see in a market rate where your blanket debt and your membership sales equals your total development cost takes on a different look. So you have a gap between total development cost and your total blanket debt and your membership sales. And that gap is filled by what we call soft money. And that soft money, as I stated before, comes from several different sources. And it's really based on state funding availability and local funding availability right now. There are not a lot of federal grants available for cooperative housing. That may change in the near future. I don't know if I mentioned this to you before, Vernon, but I did have the opportunity to work recently with the House Financial Services Committee to help them craft some potential legislation to promote the new development of limited equity housing co-ops through the Department of Housing and Urban Development. And that legislation should be coming to fruition, or not fruition, but at least up in the House at some point in the near future. So there might be some resources on the federal level at some point in the next year or so. But most of that gap is funded through local and state resources. The specific group that I'm working with, Forterra, happens to be master at fundraising. So there is a portion of that gap that's being funded through a fundraising effort as well. Which and usually that, as I called it before, soft money has no or minimal repayment terms and have affordability covenants tied to them. So they help maintain the affordability of the project on into the future.
So in the district, they have something called, it's HAP. It's funding that the individual can get or the project can get that the city puts up, or the state, when D.C. becomes a state, puts up to get this housing and money that the state would put up. So I understand what you're talking about, this gap money. So I have, okay, so you have a blanket debt that the cooperative, so you have this Forterra Cooperative, which is an entity. They take on this blanket debt. And one of the reasons that co-ops are so beneficial is because a lot of times the members do not have the credit score that they could go out and get a loan. So if Forterra as an entity has the back enough soft money that somebody would loan them this larger piece of the development cost, the blanket debt, then the entity takes on, 70, 80% of the cost of development. Is that kind of like what happens? Is that what you're talking about?
Yeah, it's a very flexible model. Yeah, and it depends. The primary source of blanket debt there's really, for cooperatives outside of New York City, the primary sources are either government-sponsored entities, including FHA insured mortgages, and that's what I do. That's the 213 program. Fannie Mae also provides blanket debt, but they don't do development funding. Freddie Mac does provide blanket debt in certain markets, but not all markets. And NCB also provides development funding and blanket debt.
National Cooperative Bank provides.
Yes.
Your old boss.
Yes, exactly. My old boss. I love those guys. I will never not appreciate the time I spent there, because it really has molded my whole life, to be honest. But those are the primary sources of blanket debt. And the best terms as far as blanket debt that you can get is through the FHA 213 program. That's a mortgage insurance program run by the Federal Housing Administration. They run mortgage insurance programs for multifamily projects and assisted living and hospitals. And cooperatives fall under the multifamily section, although it's the 213 program is exclusively for cooperatives. And under that program, depending on the economic parameters of a deal, you can get up to 98% loan-to-cost financing. And the financing terms are amazing, really. I mean, it's 40-year financing. Currently, interest rates are in the low threes, and that interest rate will be fixed for the construction period plus 40 years. So the cost to borrow for a cooperative right now is pretty low, and you can maximize the debt as much as you can based on that. But typically with these deals, if you're creating an affordable deal, you're looking at a blanket debt that's about 70% of the total development costs, and then your share price and your soft money covers the rest of that 30 to 40%, depending on the deal specifics.
So you really, from what you just said, I get that the blanket mortgage could cover 70 to 98% of the total development costs, depending on who's doing that. Okay.
That's correct.
2% that's left, if you've got that FHA 213, you'd only need to raise that 2% over and above the loan amount. Or if it's not FHA 213, you got to raise maybe 30 to 40% of some money somewhere. Either that money would come from the membership. They have a membership fee. The 100 people in this example have to put up something that could be as low as, I don't know, $500 to $50,000, and so they have to come up with something to help with that financing to bridge that gap. And if it's $500 or $1,000, then you have to look for that fundraising that Futura is doing. Some way you have to come up with that.
That's correct. And in the Forterra example, their mortgage is actually about 70%. And the reason that is we wanted this to be, affordable to many of the residents. And it's not mandated by any government entity, the affordability. It was mandated by Forterra and the local group that we're working with. So the rents, which with a cooperative you call a carrying charge, are artificially kept low. And because they're low, the mortgage that you could qualify for was not up to 98%, because there's also a income test as far as sizing a mortgage. With a cooperative, you're allowed to use 100% of your net operating income to size a mortgage based on whatever the interest rate is. So when you look at their net operating income, they could only qualify for a 70% mortgage as far as loan to cost is concerned. So we're filling that 30% gap with share sales and soft money.
And do you have a sense of how much the share sale will be of that 30%?
Well, yes. I don't have those numbers directly in front of me, but share sales are going to be in the neighborhood of $50,000 to $65,000, depending on the size of the unit. there'll be 1 bedrooms, 2 bedrooms, and 3 bedrooms in this project. And the affordable units will pay that same price, but their share price will be subsidized through some soft money sources. So the affordable units will probably carry real money out of the member's pocket of about $5,000 or $10,000.
So what I have found out is if you've got somebody making $40,000, the likelihood of them having saved $50,000 is almost zero. It's so small. Yeah. And if they're making $40,000, a lot of times the projects that I manage may have a membership fee that's equal to the same as a security deposit. If the rent or co-op fee was $500, then that membership fee was $500. So somewhere you have to get that gap of the difference between $500 and $50,000 has to come from soft money somewhere. In the district, that may come from HPAP, which I talked about earlier, that the district puts up that money in terms of a grant, if it's, depending on their income, grant or a low interest. You only pay back when the person sells the unit, or if depending on their income, they could pay something back monthly. But that's why it's set so somebody can get into housing. We got to take our final break, man. This is interesting. It's fun. And I really wanted to come back and talk more about the values and principles and why co-ops and who are the people that are wanting to buy this. Because I learned earlier that you have to have the demand. And you said that there's a significant interest. So that demand is there now. I want to come back and talk about that. We'll be right back, everybody. Please don't touch that dial. Welcome back, everybody. This is Vernon Oaks. The program is Everything Cooperative. We talked about, and we've been talking to Hugh Jeffers this morning about a housing cooperative. Right now, I want to go more into the example we were talking about, Fruitua in Seattle, Washington, and the different layers. We talked about the layers of financing, and I like Hugh's example. It's like baking a cake. You have many different layers of baking a cake. And in housing co-ops, I found that you need 5 to 7 layers, depending on the affordability and the gap that you need to put forth of what people can pay in terms of their membership fee and what you can get in terms of a mortgage, normally called a blanket mortgage. So we've been talking about that. And Hugh, I said I want to get into this segment, our last segment of this show. We got to have you back on again because this is so exciting to me, hopefully to other people out there. So the idea behind this show is to give you information, because information is power, only if you put into action. That if you need some housing, affordable housing, you may want to get together with your mosque, your church, or some other entity to create a affordable cooperative. And as Anita Bonds has said, I said earlier in the show, that co-ops is the answer, her words, to gentrification. So if you're in a community, if you're in Southwest D.C., Harlem, Seattle, Chicago, New Orleans, anywhere, you want housing and you want to have ownership, then limited equity co-ops is a way of doing it. So you have to get the funding from somewhere, and you could call Hugh. Hugh, how can they get a hold of you?
Well, they can reach me via email. My email is hjeffers@centennialmortgage.com. People could give me a call, too. My phone number, I'm happy to give that out, is 202-415-1862. I'm available to help. And like I said before, I wear 2 hats in the cooperative world. I can bring resources of the National Association of Housing Cooperatives to them through the Development and Preservation Committee. And I can eventually provide funding to new co-ops.
So I got HJEFFERS at Centennial, CENTENNIAL.com?
No, centennialmortgage.com.
Okay. So H. Jeffers at centennialmortgage.com, or you can reach out to Hugh if you're in a community and you want to start a limited equity co-op, he's a good place to start. He can help find a nonprofit developer, a developer to help you do this. In the district right now, a big name is Mi Casa. Mana was doing a lot of mortgages, but they couldn't get financing, so they started doing condos. And with the financing, with this new interest, and maybe they'll go back to doing limited equity co-ops. But it's 202-415-1862. 202-415-1862. What were you going to say, Hugh?
Well, it's funny because when I was within the National Cooperative Bank, NCB Development Corporation, which is now Capital Impact, Mi Casa and Mana were both customers of ours. So it's, they're still, it's good to hear that they're still pushing forward with cooperative projects.
Well, Mana has gotten bigger. They were also on this limited equity housing co-op with me as a developer, and they know a lot. They've worked a lot for all of the things that you've just talked about. And I would love to see Mana get back in the co-op world. But I'm also on a nonprofit board called Hope Housing, and we may be reaching out to you because we're looking at a project in Baltimore that we're looking at 3 whole blocks in Baltimore, very blighted, right around where this what you want to call that neighborhood. So we want to help develop that neighborhood, and we're working with a nonprofit there. That's a local nonprofit, which is always what entity in the community can you work with that gets the community values, like the Somalian values. What's the Somalian values? Coming together is a part of Somalia. So, yeah. So we may be reaching out to you also to put these layers together of this financing for that project.
Yeah. Well, it's amazing to me. I mean, really over the past year, how many projects really just start with a phone call and an idea. Look, we want to, we want to help bring the community together. We want to help folks that can't afford housing become homeowners. And, how do we do that? And, suddenly you have an idea that we can bring resources to that help make it a real project. And that's how these things start. Someone calls me with an idea, and that's how it started with Forterra and the Wadajir project. I have a group I'm working with in North Carolina that wants to develop a cooperative that's called Common Ground Cooperative. They want to have a farming element to it. So, I mean, every co-op is different, but it starts as an idea, and then you reach out to the people that know a little bit about how to put it together, and that's how it works. It's amazing. And like I said, almost all the projects I've worked with have started that way. They grow, sort of from a single phone call.
So you get this phone call from the idea, from the phone call to you have that's 100 units. How long does that normally take?
It could. It depends, really. Some groups are better prepared than others. I'm working with another group in Seattle that's more prepared. They have like construction drawings done and all that. So they're, that turnaround time might be 12 months. With someone calling me with just an idea of putting it together, that development time frame can be 2 to 4 years. So it really depends on where people are when they start the process.
So my experience says it could be 5 years, depending on what the project is, how much the money is, how knowledgeable the people are that's trying to put it together, how much training they must have. That's the 5th principle of cooperative, is training information. And it's all about how you get them trained up to how they work together as a community, how they solve problems together. There's always going to be conflict. I have one idea, and Hugh Jeffers has another idea, and how do we solve that together without coups and all of this messy stuff, which is one of the other reasons I like co-ops, because that's the training that happens. Okay, so it's 1 year to 5 years or so if you get started.
I think
it may take some time.
Valid. Yeah, that's a valid time frame. And again, it depends on where you are in the process when you make that call to organize this. So,
I read a research project that looked at HUD-funded co-ops versus HUD-funded apartment buildings. If you haven't seen, I've been trying to find it. I had it. But every variable you could think of, the co-ops outperformed the apartment buildings. physical plants were better over long term, 40 years. It had history now, 40, 50 years. The physical plant was better because the members owned it and they made better decisions than the investors did. And the physical plant, the quality of life was much, much, much better. They get financial wealth. They got social wealth. They got political wealth. The foreclosures were much less, almost zero. The HUD funding, Herb Fisher told me about this, but HUD has some kind of insurance program for these projects. They had gained money, gained interest. Nobody almost used that money because there were these foreclosures. Rents were much lower. In Atlanta, a two-bedroom was running $500. I went and visited this co-op in Atlanta. Down the street, the apartment buildings were $700. This was after 30 years. So the opportunity cost was not even included in their savings or investment financial wealth, but they paid $200 less a month. That could go to child college or all kinds of different ways of in creating wealth. Rents were lower and, of course, increased savings, which also did not include you get to write off of the property taxes and insurances. So co-ops outperformed in every way possible for the people, for the members, for the people that work there. If you're in an apartment building, you have no say. And you're subject to the investor, and he's only interested in, most investors are interested in return on investment, and that's it. That's what I learned in my MBA program. What's the highest return on investment? That's the decision you make.
That's right. That's right. Well, the cooperative model, by definition, is more affordable than any multifamily rental. It removes that profit motive to the operations of the property. So as a member of a cooperative, you're only paying for whatever debt you have on the property plus whatever the operating expenses are of that property. The real estate taxes, the utilities, garbage collection, things along those lines are all paid for collectively. And when they're paid for collectively, they're usually cheaper than what you would have to do if you were a single-family homeowner. So the model is really about creating the most affordable home ownership that's out there. And to go back to your statistics you were quoting about the HUD-insured programs, and that's primarily the 213 program when it comes to cooperatives, although there were some affordable cooperatives created under a couple of programs that don't exist anymore, the 236 program and the 221D3 Beamer program. It used to be, they don't do this anymore, but it used to be because there were no losses in the cooperative mortgage insurance fund under 213, that the members or the borrowers from that program actually received a refund of their mortgage insurance every year. That's never happened in any other program because there's always losses. So yes, the model is significantly better when compared to other multifamily models as far as maintaining plant, as far as viability and long-term affordability.
So here, we only have a couple minutes left, but I did not like limited equity co-op because in the district, being an African-American, I thought this was white folks' way of making sure that blacks did not get any equity. It's called limited equity. But over time, when you look at the choices that somebody makes that's 40% of the median family income or 80% of median, they don't have the opportunity to buy this single house with the white picket fence and dog and 2 children. That model is not available for most African Americans, Hispanics, and Native Americans. It's just not available. So when I look at the options are apartment building or limited equity co-op. The limited equity co-op outperformed the apartment building and everything we just talked about. Okay, right. Everything. And the social part of it is, and I've been in meetings as a manager where the people would say, well, I know who's selling the drugs down the street, and then they call the police on them. So you have less crime in a limited equity co-op than you would in an apartment building because people take ownership and control, and they know how to work with police or they know how to work with government entities or other entities to get help. So it outperforms them in every way. I love them now. And it's a way of building wealth. Okay, you still build wealth from all of the reasons we just talked about. And therefore you can, and I've seen people do this, go buy that house after they've lived there for a while. So it's wonderful. Sure. So what's in the last minute, what message would you like to leave people with?
Well, the message is that, cooperative housing, limited equity cooperative housing is a way to build a community, to uplift people, to create wealth, and to create stronger communities. And I'm working with groups all over the country that want to do that. I'm working with a group of Black doctors and health professionals. It started out as a Facebook group. Sorry, I talk more about that the next time.
We'll have you on the next time. Call Hugh Jeffers at 202-415-1862 if you want looking at an idea, have an idea, or you have the plans. Call him and he can help you. Hugh, thank you very much. We'll have you on again as soon as possible because you have other examples I'd like to talk about. Everybody out there, please we'll see you next Thursday. Please live cooperatively and have a wonderful week.